guys, my name is Jo and I'm the CEO of Navistar Legal, and today I'm interviewing Simon Atkinson from Marlborough. Welcome, Simon.
Hi, Jo.
So Marlborough is an ethical investment company and they purchase SMEs, small and mid-sized businesses that the owner has a life reason for leaving. Simon, tell us a little bit more about what you do and how you do it. What is an ethical investment company?
Okay, so when we formed Marlborough, what we were doing, in essence, maybe isn't that different to what other people do. I mean, lots of people buy businesses. We are investor buyers, which is effectively we're not trade buyers. We're not a manufacturer buying part of their supply chain or another manufacturer. But we wanted to be clear when we started it that there was something. Not just that set us aside from others, but made us feel right about what we're doing. And to that end, when we say ethical, we're very committed to making sure that whatever arrangement we make with the seller of that business genuinely benefits them. So we're not looking to pick up distressed businesses. We're not looking to pick up businesses for a fraction of their real value. Equally, by the way, we're not looking to pay 2 or 3 times the real value, but we're looking to give a genuinely fair outcome to somebody who may have built that business up for a very long time, 20, 30 years. And the reasons for selling, you said a life-changing event, perhaps. It could be illness, it could be retirement, it could be a genuine desire simply to do something else, but we want their efforts to be appropriately recognized and rewarded. And when we take that business, we're not just going to run it as it has been run. We will do that, but over the top of that, we're going to grow it. We're going to improve it as best we can. So everybody wins. So that's what we mean by ethical.
That's actually the words that were coming to my mind. I was thinking of the kind of win-win-win triangle. Yeah, everybody is benefiting, and it's not a win-lose or a kind of attrition where nobody wins, and that's great. I know you're quite experienced in business, so I'm keen to hear a little bit about. I want to hear more about Marlborough, but I'm also keen to hear about your experience in business and your attitude to risk. So I talk sometimes about a scale. I know when we talked in Manchester, I probably mentioned this scale. 1 to 16, and you laughed. You were like, 1 to 16? What does that? Why is it 1 to 16? But we had a scale of 1 to 16, 1 being kind of take no risk, 16 being go with the risk, do whatever you've got to do, dot no I's, cross no T's. Where do you see yourself on that scale, and how do you kind of manage risk, both in Marlborough and in other businesses?
Well, personally, I'm fairly prepared to take risks as long as they are intelligent risks. Where that is on your 1 to 16 scale, I'm not really sure, because I don't really know what those numbers mean, but it's certainly going to be in the top 25% somewhere. In terms of how do we manage that risk in business, I think personal risk and business risk, there are some things that are the same and some things that are quite different. With business, there are certain checkpoints and processes that exist by the nature of business, in terms of what you will work through with your accountant, with your bankers, with your lawyers, with any other source of funding. The stuff that you just have to do, and you should do. And I think that creates a framework for your ability to deal with a risk. That doesn't exist so much in personal lives, so it's arguably easier, in my opinion, to take personal risks than perhaps you would in business. Plus, also, there are people depending on you in both cases, but generally in business, it may well be a lot more people, because you're probably going to have a bigger company than family, unless there's something seriously awry. So I would therefore think that in business, you can manage that risk within that framework, and you can adjust that risk up or down according to your nature. Now I often find with clients, with companies that I work with, you usually find that you get a balance of that at the board level, and usually the MD is more keen to take risks than the FD.
Mhm.
FDs are generally, by their nature, more cautious. I do have a client where it's the other way around, which is actually seriously quite weird, but it still works for them. I don't think there are probably very many companies where everybody's happy to take risks, unless they're startups and they're heavily backed, and they tend not to last very long. So yeah, from my perspective, I think I would manage it according to the different people on the board, and you look at each type of risk and with its merits and demerits at the time, really.
You just focus on the risk at the time. There's no particular. I mean, I know you, and you're certainly what I would think your attitude to risk is. You're willing to take risks. You're not willing to take stupid risks, and but you're also not in a position of where that's going to cost you a lot of money, or where there's going to be kind of a breakdown in a relationship. It's kind of a no-go. That's the way I see it with you. But if it makes sense to all, then you'll probably take it.
Yeah, I always try to have a plan for something. So I think it's fairly well known that you should never enter into something without an exit plan. Not necessarily thinking of lockdown here, but that. So for me, if I was going to take out funding for a business, I would obviously want to know that I believe that funding can be repaid.
Yeah.
Okay. For example, I'm sure there are people out there who are a little less scrupulous who perhaps take out funding without knowing that, or possibly in hope rather than in expectation. So I would always have a plan for dealing with that, and ideally a backup plan. But that would not stop me taking the risk in the first place.
Yeah.
If you see what I mean. Because if you don't take risks, you can't build a business. You can't be an entrepreneur. Effectively, you're stuck in a channel, really.
Mm-hmm. Absolutely. And well, I'm curious. Have you ever taken a risk that you wish you hadn't? Is there anything in your head where you're like, God damn it, I wish I'd never done that? I can tell you one that's on my mind right now. Not yours, but mine.
Look, I must have taken plenty of risks that I wish I hadn't. I think probably the ones that spring to mind, which aren't common but have happened, are more about hiring, actually, where maybe I've hired somebody and I probably wish I hadn't hired that individual later on, or conversely, someone's left and I wish perhaps I've been able to keep them. I appreciate that's arguably not a risk, but I think that hiring is a massive risk. A bad hire is going to hit you. Not just on whatever that individual does for a period of time, but also on the opportunity cost of not hiring the right person. And I've definitely been down that road.
It's interesting with the hire, because you say, oh, that might not be a risk. And it clearly is, but it's almost one that we never think of as a risk that we need to consider it in the same way. Like, you need an exit plan, or you need to make sure.
Yeah.
Because you think, well, it's just hiring somebody, and obviously I know what the options are here, but actually hiring somebody is a big risk. The potential for things going wrong, and the potential for, because it's never quite as predictable as you think, hiring somebody, is it?
No, it's not. And in business, I've hired people. I was in IT, and that tends to have some quite highly paid, high caliber people. So if you hire a salesperson, HR will tell you to minimize the risk by having a probationary period. The problem is a probationary period is normally 3 months.
Right.
But it's going to take 9 months for a big ticket salesperson to be productive. So the probationary period is virtually useless anyway.
Yeah.
It doesn't actually give you any real benefit. So you're going to be into 9 months to a year before you, unless you've made an absolutely disastrous hire that's really obvious, which often is not the case, but you may well have a long period of time before you're able to change course.
Yeah.
And that is quite a big risk if you're quite dependent on those hires that you make.
How does that translate into M&A, I wonder? How does your risk profile transfer into M&A, or are there any ways that you mitigate risks in your purchases or in finding the right people, finding the right deals? I mean, the thing that's just coming to my mind is when you're purchasing these businesses, often you've got people who are still going to be working for you. And
Yeah.
how do you mitigate that?
Well, M&A is the ultimate caveat emptor, isn't it? Buyer beware, right?
Yeah.
So therefore, you have to do as much as you can before you actually press the button on the acquisition.
Yeah.
I've been through a lot of acquisitions in my time. I've been in companies that have been acquired, and I've been in companies that have acquired. And I've seen some pretty horrendous examples of how not to do things and the opposite. I think in terms of how you deal with that risk, if you like, the people risk. The people are in situ anyway. I think the general risk in this is really all about plugging people into the acquisition process that do things you don't. So I think it was George Bush Jr., wasn't it, that surrounded himself with smarter people than himself, which wasn't difficult, but he did that on the basis that he knew, and actually he should be given credit for this, that he wasn't the smartest guy in all of those areas. In fact, probably in many areas. So he made sure he surrounded himself with people who were smarter than he was to deal with it.
Yeah.
Now, I'm not comparing myself to George W. Bush. But what I would say is you've got to bring in people and point them at the issues. You know, we have someone who does a lot of the financial work for us. We have yourself on the legal side, and we have others. And we also have access to this huge bank of people with very, very specific domain knowledge from our other businesses. And that gives us a lot of expertise to call on very early in the process. So ideally, if we can sniff something out that's not quite right, it allows us to take a view on it.
Yeah. Great. Negotiations. Now I know I'm going to say in your day job, because I know you've got fingers in different pies. You do different things. Negotiation. You're the person that I would come to say, right, negotiation wise, what would happen? Because that is effectively what you do, isn't it? You negotiate a lot. You're involved in a lot of negotiations. Tell us about. Are there any top tips that you could give? Top tips. I hate that phrase, but any top tips?
Yeah, we do. We do get involved in a lot of negotiations, supplier negotiations, and so on.
Yeah.
And of course, we negotiate a lot in the business acquisition side, which is arguably harder, I think, because when you're acquiring something, you are, in a strange way, you're not just the buyer, you're also the seller, because you're buying a company, but you're selling yourself as the buyer to the seller, which almost sounds like the rules of cricket, you know, where you're in until you're out, as it were. So because of that, you're operating in a very different way. It's not like you're having a simple one-way negotiation with a supplier who wants to sell to you, and you know they want to sell, so you can kind of hold the aces. Here, it's much more fluid, and you're not really sure quite whether the information you're being given is fully correct anywhere, or whether it's just a position. Top tips, pretty difficult, really. I think most of mine will probably be the same as anybody else's, which is start out knowing what your goal is and what you're prepared to walk away from, and don't deviate from it, and don't let somebody else dictate the terms or the time scale. I think you can be a hard negotiator without being unpleasant. And I think that also puts you in a very good position, because ultimately, actually, you know, you kind of have to own it. And to own it, you have to get on top. And I think that's to me is the key thing, is getting to be on top in the negotiation.
Right. Yeah. And And is that win-win as well? I think with you guys, what I've experienced with you guys is you will get, there's a position at which you'll say, right, we're getting on top, but you're fair with it. So for me, like the way I see it with negotiation is I trust myself most. So I'm able to get, if I'm able to get a strong position, almost I can come from a fair place. Whereas when I'm the underdog or when I've got no power, that the other person may not come from that same place. So there's a kind of trusting that you're going to come to a win-win from that position.
Yeah, I mean, I think also it depends who you negotiate with. If you're negotiating with a seller, then it's about building a relationship. If you haven't got that relationship, then it's going to be difficult anyway.
Yeah.
If you're negotiating with an advisor, I think it's a slightly different thing. Then it's less about the relationship and more about the trust.
Yes, that's true. Interesting.
I think with an advisor, if I don't trust them, then I'm going to have a different stance.
Yeah.
Really, I'm not talking about our advisor. I'm talking about the seller's advisors.
No,
and with the seller, if we go on with them and we genuinely believe them and we are working towards the same goal, then it'll be a lot easier.
Yeah.
And we've seen examples of both in the not too distant past, and it really shows the difference.
Yeah.
Because at the end of the day, the goal has to be the same. Whatever we want out of it has to be the same as what the seller wants out of it. Because if it's not, it's difficult to see how that's going to fly.
I would say it's more than difficult. It's probably impossible, because if you don't want the same things out of it, there's no deal to be struck, is there?
Well, it won't be a win-win. It'll be a win-lose.
It's impossible to get a win-win in that position. So yeah. Is there anything, so in the M&A world that you're in and kind of seller, buyer, are there any myths or are there any things that you think ought not to be out there, the kind of beliefs that ought not to be out there or that are unhelpful in the world in which you are operating?
Yeah.
Yeah.
Yes, undoubtedly, Joe. The one that springs to mind the most is unrealistic valuations, where one of the main reasons acquisitions don't happen is sellers' unrealistic valuations. Now, they may get them from all sorts of sources, but one of the chief culprits is unscrupulous brokers,
right,
who really make most of the money from the initial fees from setting the whole thing up in the first place, will convince a seller that they can get a far greater amount for the company than it's ever going to fetch. And then 2 years later, 3 years later, it's still unsold. They've parted with a load of money. They're not happy. The only happy person in it is the broker. I think that should be much improved.
It's so interesting that you say that, Simon, because I literally had a conversation with a broker who said exactly the opposite. and so I find this to kind of it's such an interesting dichotomy, because the seller, my experience is the seller has has zero knowledge of selling or likely buying. So they have no knowledge. So they have to go to experts in the field, usually a broker, to get this information, and to understand what's the norm. And I think that's what I see. My job is not to necessarily tell you what's legal or not legal, but what's usual and not usual. That's the kind of experience that you can add to the equation. And I was speaking to a broker, and he would say, the myth out there that is that you can buy a company for £1. Now, I know that's not what you guys do at all, but there is that environment around deferred consideration, and that actually sometimes the money that's exchanging on completion, not that I've seen this with you guys, but money that's exchanging on completion may be very little, and that actually later on, that's where the payments go, either earn out or deferred consideration.
Yeah.
It sounds like the buyer is getting a good deal. It sounds like, oh, you're just buying it from, this is the way you're buying it, and that doesn't really mean much. But actually, as long as there's a win-win-win, and this is what I was sharing with him, a lot of my clients do this, and actually, if it's a win-win-win, surely there's a benefit to that. But I agree. There's different parts of the market, aren't there? And there's parts of the market that will say we're only going to go for this type of sale, and we refuse to do anything else. And there's I totally agree with you. It's so interesting to see the two, different views Literally.
Well, yeah, I mean, I think if brokers have got a different opinion to that, then they should put the money where the mouth is and take a lot more of the fees from a sale over the threshold, at or over the threshold they're saying they could do, which
Yeah,
which most of them are not doing.
yeah,
Now, I mean, yeah, there are many different models, and I think I know who you're talking about, the pound model. I think there's two questions you've got to ask there. The first is, what are you getting for a pound?
yeah,
First of all, clearly this is not going to be or a hugely viable trading entity if that's going to be the upfront payment. The second is,
yeah,
if it is viable, why is it being sold for a pound up front? More to the point, all of the repayments are going to come out of the profit and loss of the trading over the next 3, 4, 5 years. So that's a huge stress on the P&L. It simply doesn't make sense.
yeah.
And
And I think,
it cuts right across our ethical viewpoint.
yeah, and I think the £1, as I was saying to this broker, it's not that people buy it for a pound. If they're buying for a pound, it's usually because it is insolvent, and then they're taking on part of. I think there's different perceptions of actually what people are buying. So what you would buy you would never purchase it for a pound, because you're buying profitable companies that are doing well and they're trading well and they've been operating for a long period of time.
Yeah.
There are other strategies of buying other companies for a different methodology. So yeah, it's really interesting to hear different people's perspectives in the same arena.
I mean, there's another one. There's a guy I met a few weeks ago who's got a very interesting business where he advises owners to sell to their employees, and he sets up the trusts, and that's very tax efficient. They don't get as much on their completion as they would with us,
Yeah.
but they remain on the board for some time, and they then get a good cut of the business trading, and they look after their employees because their employees effectively, through the trust, become owners of the company. That's great. We don't do that, but we do like partial acquisitions, in effect, where there's an equity rollover and we can keep a key director or directors in situ, because then that comes back to the risk. It lowers the risk. It's better for them. They'll get more money in the long run. And why would you not want to keep somebody on who's built a business?
Absolutely.
From a risk perspective, it's brilliant because funders love it. We love it. It works for everybody. It's a good example of a win-win. And when we do that kind of thing, we usually talk about an equity rollover of maybe 20, 25%, something in that region. So, it's big enough to be interesting for them, and it works.
And it takes some of the pressure off of them. Like the way that you do it, with that part equity, it takes some of the pressure off them. They get a team then, don't they? Instead of them just being, right, I'm on my own, I'm slogging. There's a fatigue. It's not even exhaustion. It's like a fatigue that happens when you're on your own and you're making things work. Then you've kind of bring in a team that isn't a different.
Exactly. They're part of a team. It takes a lot of pressure off them. So ideally it allows them to do what they've always done, but with less to worry about. And they've got a whole load of money.
Which has got to be a benefit and a bonus. How do you see, what are you thinking around the SME and certainly SME purchasing? I am going to ask you about how things have changed for you, because I'm curious about that. But I just wonder what you're seeing in the not too distant future being kind of opportunities within the M&A market, certainly at the SME level.
I think it's very difficult to see at the moment because so much has happened in such a very short space of time.
Yeah.
We kind of, we only have to go back a month and things are very different. It's really very little time altogether. So what I think is going to happen here is that I think today the current situation is we're in lockdown. That's not going to last that much longer because it can't. Economically, it simply cannot go on forever, whether it's partially or fully relaxed, whatever. But we will see a change there. What concerns me is not the fact that companies might have been mothballed for a couple of months. In some cases, it's more what's going to happen coming out of it, the tail of that, how long it takes them to get back to where they were. Now, I do think, actually, as a general species, we are quite glass half empty, doom and gloom, and the media love a bit of doom and gloom. Sells more papers than positivity. So I do think that we will recover more quickly, I think, than people think. But I think from an M&A perspective, it will have an effect on valuations, because you've got to look at the trading levels and profit levels of the target company. And they're not going to be what they were. At some point they will, but we don't know when that point is. So I think it may have an effect on both valuations and deal structures. Where probably, to be honest, I think it's been pretty benign for sellers for a while. And I think the seller advisory market, the brokers and so on, have certainly capitalized on that, where you've seen a lot of deferred, high completion percentages and deferred payments. I think what you're probably going to see more of now will be probably lower completion payments and earn out rather than deferred, or a mixture of the two for a while.
Because I guess with the earnout, that allows them to say, you know what, this is not the norm. We're down here. This is not the norm. This is the norm, and we can get it to the norm pretty quickly.
Exactly. It means that if you do hit those numbers, you're going to get the money that you believe you should get. So I think that there'll certainly be a change in those areas. I think there'll be a lot of unsold businesses. I mean, there's a lot anyway, but there's going to be an awful lot that are going to be sat on the shelf for a while. So people who need to sell will have to be quite realistic about it, in terms of either valuation or stretching it out. It's just not going to be like it was for another year or two, I think.
Yeah, absolutely. Well, there's definitely changes afoot, unprecedented times, as people say. Tell me, I mean, I'm curious to know two things before we shut down. So the first one is, what type of what's useful to you? What type of businesses are you looking for? If anybody happens to be in those businesses, tell us a little bit more about that. And how do people get in contact with you? And how do we get in contact with you and the Marlborough Scott team?
Okay, so the sort of businesses we like are solid trading businesses. We don't look for high growth. We don't look for sort of e-commerce or social media type businesses. So we're not going after if you like, the fashionable end of the market. We look for solid, long established businesses that consistently trade profitably, relatively little change. They do the same thing year after year. And they now have a situation where the owners of that business, for whatever reason, no longer wish to carry on doing what they're doing. They want to either extract some cash, carry on for a little while, maybe they want to retire, or maybe, rather sadly, there's been perhaps an illness or a life-changing event which forces a sale, or a rethink leading to a sale. So those are the type of businesses. What do? Well, they will be normally manufacturing, distribution. They will usually involve products, maybe services, but they're unlikely to be pure service businesses or people-based businesses. For example, a professional services firm, we wouldn't acquire that because the asset is the people, and the people could simply go and start again somewhere else. It wouldn't make sense to do that. Really, that kind of sums it up. We're not putting too many constraints on that. We'll look at anything in those areas, and the key thing is that it is a viable, profitable business, and there are people who genuinely want to sell it. That makes sense for us. How do they get in touch with us? The easiest way is to go to our website, which is marlboroughscott.com. There is a contact form on there, which always comes to all of us. And it also gives information on what we do and how we do it first. So it probably gives them a good steer on what they might want to put in that contact form. Really. Otherwise, LinkedIn. I mean, people can always contact us through LinkedIn.
Yes, got it. And you'll be under Marlborough Scott, so you can look up Marlborough Scott on there. Great. Simon, thanks so much for joining us today and give us a little insight into your businesses, your predictions.
You're welcome. Thanks, Joe.
M&A market. It's really good to have you on board. Thank you so much for sharing.
Thank you.
All right.